Great. Thanks. Good morning. I'd like to thank you for joining our presentation. My name is Lon Shaver with Silvercorp Metals, a stable and profitable silver producer positioned to grow. Before I get started, just want to draw your attention to this cautionary statement slide. We'll be making forward-looking statements, could be affected by a variety of risk factors as laid out in our AIF. Typically, I wouldn't begin with this slide, but given the recent headwinds our sector and our stock has had, I thought it would be important to really just highlight the compelling value proposition that Silvercorp is at the current time. You can see from this slide, over the past 5+ years, we have grown our cash balance up to 216 million in cash. And we've done that while continuing to invest. You can see in the bottom of the slide, cumulative capital expenditures over that time frame, 249. We've made investments and we've continued to pay a dividend, 24 million over that time period. So we've done all of this cash building and reinvesting our assets from operations, and we'll get to that in a second. But I think it's important to look at that at a current market cap of 409. If you did back that cash out of 216, and if you backed out just the market value of our investment in New Pacific Metals at 95, you're really looking at an adjusted enterprise value of just under 100 million. And so on a look-through basis, that's kind of what the market is paying for our mining assets. Mining assets, the analysts say, have an NAV of 592 million. So I'll get into the mining assets in a second, but why don't we sort of clear the decks on what are the easy things to talk about. Let's talk about the cash. 216 million in cash. We have no debt, and we've done no equity or debt financing since 2010. So what can we do with that cash? Well, we can continue to pay our dividend, 2.5 cents per share per year. And we do have a share buyback program in place. We have used it, and we will use it when we think the time is right. But really what we're holding this cash for is to look at targets, acquisition targets or investment targets. And we're focused really on projects with defined resources and where we can see the potential for a high margin project, ideally looking at long life potential. And we're really aiming to find something that we can acquire and build into a free cash flow machine that will add to our existing cash flow for the company, and something that we can develop within reasonable capital expenditures and timelines. We're not looking at mega projects that are going to take 5-10 years to scope out, permit, and construct. A couple of years ago, we had what we thought was going to be a good target. That was Guyana Goldfields. It was a company that had really been abandoned by the marketplace. You can see strip ratio on their open pit went from 2.2 to 15.6, and the grade was cut in half. And so the stock got trashed in the marketplace. But when we looked at the data, we could see a high value underground operation, and that's by remodeling the resource. And so we entered into a friendly deal to acquire the company for 60 cents. And then when somebody else came out, we entered into a revised deal to acquire the company at $1.30. Ultimately, we were trumped by Zijin at a cash bid at over 3 times our original offer. So while we didn't get the asset, we did make $20 million on a break fee and on a toehold position. So sort of an example of what we'd like to do, and we're constantly scouring the world for other good projects that we think are a good fit for us to acquire. Now, one of the other value assets contributing to our value stack is our investments. And I talked about New Pacific. We've put just under 40 million into New Pacific between 2017 and 2020. And we currently have a 28.2% stake. We've provided some support, which helped the company get going. And you can see, a very attractive initial resource was put out in early 2020 for a pure silver project with an M&I of 155 million ounces of silver and inferred at 35 million. More to come on that. But at a current market cap, New Pacific represents about a 2.5 times return, and we think there's further upside from here. As of June, our other investments worth about 15 million. So why invest in New Pacific Metals? Well, really, the original story was silver sand, and that's been a phenomenal story of growth and resources. You can see the resource here summarized. But after another 20,000 meters of drilling this year, the company intends to put out a resource update within the next month, complete a PEA by the end of the year, and is moving ahead rapidly into permitting and pre-fees next year, targeting to have this mine in production in 2025. But there's more to New Pacific. They've added to the pipeline. namely the Carangas project and the Silverstrike project, both picked up for largely the same reasons of having been historical mining districts with good prior mining activity and things we could see that could be seen on the surface. Carangas has gone from really a discovery story with first assays from the 2021 drilling out the beginning of the year, leading to a ramp-up drilling program, and the company's targeting to have an initial resource out next year. But what's really exciting, it's not just a silver project, there's an extensive gold system below the silver resources that have been found. Silverstrike is newer and younger, has only had one drill rig drilling starting this summer, but the initial results that were put out last year were nothing short of spectacular in terms of identifying a open pit potential oxide gold project. So now let's shift over and really talk about Silvercorp's assets. What do we have? Well, we've got two mines in China that have been operating really for 17 years. The flagship is the Ying Mining District, which is 7 mines feeding into 2 centralized mills, and the GC mine in Guangdong province. Both these operations produce the same product, a lead concentrate with the silver in it and a zinc concentrate, and those are delivered to smelters in China. And all told, since the company began with lead and zinc, Ying alone has distributed profits over $520 million to shareholders, and we still have a plus 15-year mine life remaining on those. Won't talk a lot about the BYP mine. It was a lead zinc mine that's on care and maintenance, but we've identified a gold zone there, and we're looking to get a permit to bring that into production. And we might as well tackle the China question. We actually think there's a lot of advantages to being in China. I talked about being close to the customers. So these are the same smelters that all the other mining companies are delivering to. But rather than trucks and trains and ships, our customers actually pick our concentrates up at our mine gate. So that's really got some advantages, and we have very good payment terms. We're close to suppliers. Everyone in the mining industry needs reagents, supplies, equipment. Well, China is where it's all made. Competitive market, we get access to that. We've got a stable and disciplined workforce. The mining regulations have been stable for many years, and we found a way to operate within that. And we do have a free market. I mean, if we wanted to, we could export our concentrates, but as I said, it doesn't make sense given the arrangement that we have. We have free profit distribution outside of the country, and we're not the only ones that think that China is a good place to be. You can see that in 2021, foreign direct investment surged 20% to $173 billion. And I think if most investors looked across their portfolios and at stocks in the Dow Jones, the S&P, or the NASDAQ, I think you can find that many of these companies have extensive exposure to China, either directly with assets and facilities or indirectly based on supply chain. So our silver production has grown very modest, 2 million ounces in the first year, up to now where we're targeting for this current fiscal year. The midpoint of our guidance is 7.6 million ounces. You can see the blue bar, the Ying Mining District is the big producer here, but GC is also in the red bar been a fairly steady contributor. Also note that 7.6 million ounces includes a ramp up in our gold production, so it's being converted into a silver equivalent basis there. In terms of inventory, again, a story of growth from no reserves and resources, the red bar, to where on the last report we had just under 115 million ounces in the proven and probable category. That's included in the M&I of 211, but that 155 of inferred was on top of that. So again, a good mineral inventory. This slide really just shows a little bit of our operating philosophy. We're not just looking at producing ounces, we're looking at maximizing revenues and cash margins per unit of activity. And in this case, looking at ton of ore mined. So the blue line is our realized revenue or NSR per ton. The red line is our all-in sustaining cost per ton of ore mined. So if you take the blue line, subtract the red line, you get the green line, which is our profit per ton or an all-in sustaining cash margin. And you can see that's been consistently positive other than a few exceptions. And we've been able to generate that cash margin even in those years when silver prices were lean. The asset quality we have, you can see at the bottom, all-in sustaining cost was $9.25 US to produce an ounce of silver. That's net of our byproducts. And that asset quality is what leads us to have those healthy EBITDA margins, which have been higher and generally more stable than our peers. And our return on equity at 10.1% in the last quarter also has been higher and much more consistent. And going back to my original comment on the slide, that return on equity really doesn't factor in two major assets in the value stack, being the cash and the investment portfolio that doesn't really generate a return currently. Assets have generated consistently positive adjusted net income on a quarterly basis, other than that one calendar quarter 2020-wide COVID shutdown. But since then, again, continue to generate consistent profits and free cash flow consistently positive on a quarterly basis. Other than that calendar seasonality, the Q1 is Chinese New Year. And so our operations are shut for a minimum of 2 weeks during that holiday period. For those of you looking for silver exposure, we've got one of the highest in the sector at 54% in the last quarter, gold being 3%. Expected to grow, however, and base metals at 43%. Now, I talked about growth at the beginning. Really what we're looking at Ying is an opportunity to grow our production base. We drilled an astounding 629,000 meters of exploration drilling in 2 calendar years, 2020 and 2021. We have 80 rigs currently at Ying drilling across our 7 mines. Now, a lot of that drilling really began because we were looking at this newly discovered gold veins. You can see that third bullet in the resource area. But that expanded as the research project identified low-hanging fruit in the traditional silver, lead, zinc mineralization. So we're drilling above, below stopes that we've mined before, targeting shallower ore, which of course is cheaper to mine, and also step-out drilling on strike with existing veins. That's what's allowed us to ramp up our production guidance. You can see 17% in silver, 9% in lead, and 24% in zinc, but basically a doubling of gold production for this current year. And that drilling is going to feed into an updated 43-101 report for the Ying Mining District expected imminently. This kind of drilling also is looking at deferring the mine development at depth, which of course gets more expensive as you go deeper. And with that drilling and looking at areas where we've been before but didn't get it all means less tunnel development and sustaining capital. Feeding into the Ying District growth potential, we acquired a satellite project a couple of years ago for a modest $13.5 million. It's 33 kilometers north of the mining facilities at Ying, and we can see that ore could be trucked to the Ying mills. The plan for this year is to drill 12,000 meters. We applied for a mining permit. When we get that, we'll look at ramping in and ramping that up as a satellite operation. And to accommodate the future growth, we've announced that we're going to be building a new 3,000 ton per day mill and a new tailings storage facility. We were working on the initial design and engineering and got some permits, and looking at really a fairly modest $70 million combined cost for both of those to add to the Ying Mining District. I talked a bit about new discoveries. Just wanted to sort of highlight here that at Ying, HPG, that's one of our mines. We've hit into a zone much wider widths than we've traditionally seen, with interesting gold, silver, but also the traditional lead and zinc. Also at HPG, the bottom, some narrower intercepts, but some very high gold grades, and sometimes just gold, 25 grams, you can see 9 grams, 10.5 grams. But then there also at the very bottom, we got 17.1 grams of gold with 300 grams of silver and almost 19% lead. So some very juicy material. Now, LMW, that's another one of the mines in the Ying Mining District, hit some very interesting gold grades. You can see at the top, but then in the middle there for LM26, hit some decent gold grades, but also hitting into some copper, so 0.75%, 4%. You can see LM22 also seeing 0.5% copper, almost 13% copper in some of those hits. And I'd just like to add that when we look at this mill that we're building, we're contemplating the ability to deliver not just the lead, but gold concentrate and potentially a copper concentrate to get paid for that copper we're seeing. And you can see in that bottom highlight at LM7, a fairly wide intercepts there, true width, in around 20 meters, very different from the narrow veins we've been mining, with good silver grades, lead grades, but then also copper replacing the zinc. Now, we wouldn't be where we are with a 17-year track record if we weren't doing things right with the government and the communities. Our mines have been classified as green mines. That's under a federal and central government program. You can see that that they are green in those pictures. But the other thing we're very proud of is we've had some unique and novel programs in place. So at the GC mine there on the top, not only do we have dry stack tailings to minimize the footprint, we've actually put a backfill plant. And so we're putting a large portion of our tailings back as cemented backfill in the underground mine. Not shown on this picture, GC has also had a program where we've put our benign waste rock out and made it available to the community for construction purposes. But at Ying, we've taken that a step further. And you can see that bottom picture on the right, where we've built a 1 million ton per year aggregate plant that crushes our waste rock, turns it into sand and gravel to be delivered into the local construction market. And that's basically, it's a consortium with local community groups. After we've returned our capital, which was pretty modest, the profits here will be shared by these community groups. But for us, what's important is that it's minimizing our environmental footprint and eliminating a future cost of reclamation for that waste rock. We've done some novel things in terms of wastewater treatment to reuse that water, not just in our mills, but also for dust reduction and even for agriculture in the local area. And on the right-hand side, we've gotten certificates attesting to our environmental management programs, and we've won just recently an ESG Best Practices Award in China. So just to recap here a little bit on the catalysts. As I touched on, we're expecting increased production guidance for fiscal 2023. That's our current year, as we have a March year end. We're looking at an updated 43-101 coming for the Ying Mining District. We're continuing to drill aggressively, targeting 300,000 meters plus for this current year for additional resource upgrades to extend the mine life and also to make new discoveries. We're awaiting that mining permit for that Quanping satellite project. And where we're going to complete, I think we've done 2,000 meters of the 12,000 so far. We'll see further milestones for the construction of that 3,000 ton per day flotation mill and tailings storage facility. And when that's completed, we'll have a net 5,000 ton per day capacity. And we're looking to get the permit for that BYP gold project that we think could be a project delivering between 30 and 40,000 ounces of gold a year. This slide is pretty easy to explain. You can see that from a valuation standpoint, compared to our peers, we're really at the left end of the spectrum, whether that's on an EV per ounce of silver reserves, EV to EBITDA, price to earnings, price to cash flow. And what makes it even more interesting that those EVs and those Ps really, you're embedded in those are the three assets that I mentioned at the outset, the cash, the investments, and the mining assets. But only the mining assets are contributing to the reserves, the EBITDA, the earnings, and the cash flow. Just a quick capital markets snapshot. You can see on the left our top 10 institutional investors. And when you look at all institutions and combine that with our shares outstanding, the balance is largely retail, mainly spread across Canadian and US retail investors. And you can see on the right-hand side upper, the top group are the 6 analysts out of Canada that cover us, and then we have 1 out of the US. So with that, I'd like to wrap up. I thank you for your attention.
I think we have time for just one quick question, if there is any. Then if not, I think we'll close it there, and thank you very much for the presentation.
Thank you.